Hello and welcome back. Today we are talking about volatility and why is it important to traders. Why don't we dive right in? Volatility. Why is it important? We're going to continue to our next slide over here. The VIX, S&P 500 VIX Index. It's the volatility measure for the S&P 500 set of stocks. Volatility is very important if you want to be successful at trading stocks. Traders who do not follow volatility miss a great deal of opportunities in the market. VIX represents the implied volatility for the S&P 500, as we already said. The number is published in percentage points and represents the analyzed expected market move over the next 30 days. High VIX numbers lead to high option prices, and low volatility leads to low option prices. Slide 2. When the VIX rises, this implies that there will be short-term opportunities in the market, meaning VIX will move prices will move violently, and this creates opportunities in the options and the execution of those. When the volatility is low, this represents the lack of short-term opportunities in the markets. Stocks don't tend to move as much when the VIX is low versus move a lot more when the VIX is high. Why don't I move this guy up here because he's going to get in the way in a moment. The higher the number, the more the stocks will move. So VIX between 0 and 15%, we would set up a long and short portfolio like I've been showing in the videos over the last couple of months since January 7th. VIX between 15 and 25%. We're still in the long and short portfolio, but this raises caution. We need to keep our eyes open, pay attention to what's going on globally, locally, but what is actually happening that's pushing these things up. And then finally, when the VIX is above 25%, this is opportunities for daytime trading. It's not so good for the long and short portfolio. For obvious reasons, just as it's not good for long only portfolio. Long only portfolio being the worst of the two, but long and short portfolio, it has similar consequences. There's a lot more volatility, a lot more price movement. There's a lot more risk associated to this, and you might end up losing a big chunk of a portfolio if you're not paying attention. So between 0 to 15. Long and short portfolio, things are great. VIX 15 to 25, transition stage, long and short portfolio still, but raises caution. VIX above 25%, we have to reduce long and short exposure by about 50%, meaning if you're 100% invested and all your capital is in stocks, you're going to want to de-risk 50% of that. You don't necessarily have to close off everything that you have in there, but it's good to reduce the position sizes and raise capital for opportunities. Next slide. Most of the time, long and short portfolio management is used, like we just spoke about. Opportunities are taken about 20%. So 1 out of 5 times, that's when you're going to have opportunities in the market to take these short-term, and I underline short-term positions, which can make really quick money for you. That's mostly option trading. With this long and short, I will be focusing on running a long short stock portfolio like I have been, but this also creates like VIX above 25% creates many opportunities. It's just they're not really long and short portfolio. They are more in the options, but still very important to know about. When the VIX is in between 0 and 15, we use the long and short approach like we spoke about. When the VIX is in between 15 to 25 and rising fast, we use caution and plan to raise capital, meaning reduce exposure across the whole portfolio, long and short positions, 50% of the size. When the VIX is above 25%, we switch from long short portfolio managers to daytime traders, seekers of opportunities, or alternatively sit it out altogether. And for some, that might be the best way to do it. If you're not sure what to do, sometimes it's best just to take a step back, reduce your portfolio by 50%, lock in that capital, and just disappear for a little bit until the VIX becomes stable again. When the VIX is below 25% and moving down, we transition once again into long and short portfolio management. When you see VIX come down from highs, go through the 25 mark, and it's quickly going down, it's time to start building up that long and short portfolio, increasing the exposure. We are expecting a lot less volatility moving forward. Staying long and short fully invested in volatile times is dangerous to the portfolio, like we spoke about before. If the VIX is above 25 and rising, and you are still fully invested, you will see some wild swings in your returns. And that is something we want to limit. Reducing the exposure about half is much safer approach while maintaining open positions. This allows you to lock in, bank some profit before the volatility takes much of it away. By raising cash when volatility strikes, we have capital to deploy in case of opportunities, like we spoke about. But once again, this is options, and we are not talking about options. We will talk about options in the future. I don't like options too much, but nonetheless, we still have to talk about them, and we'll get to that in another video. Volatility equals opportunity. Volatility equals quicker results. Average daily moves go through the roof when volatility strikes. Importance of volatility. There is no set of rules that works ideally every time, meaning things can happen, VIX goes up, stocks go up, or VIX goes up, stocks go down. This is the best way to preserve your hard-earned capital. Is long, short, in low volatility, and opportunistic in high volatility. High VIX does not mean that the markets will go down, and this is very important. Sometimes they can climb up just the same. VIX implies volatility, and the price swings can be up or down. It is up to the trader to interpret what is happening around the world and act accordingly. Which brings me to my next point and what I've done on Friday. So why don't we complete the quick VIX presentation here. I'm going to close off this PowerPoint. We'll dive right back into the good old spreadsheet that everybody hates so much already, right? And those of you that do like it, keep watching because there are some good things coming. I've been expanding this thing. I will eventually be sharing this thing with people. If there's something that you want to add, please reach out to me, send me a comment. I'm always open to suggestions, and yeah, I'm actually interested to see what other people out there are doing at the same time. Maybe you can improve my process a little bit. I'm building on this since January 7th. If you've been with me when I started this channel a few years back, and then there was a period of me not doing anything, I've been busy with work, but I'm finding time to do this. I make it a quick thing over the weekend, and I'll find time moving forward. Let's just keep on going with this. I really want to share with you guys, and this is a great way of trading. This is the actual right approach that they should be teaching you out there, and most of the time you're not seeing this because there's a lot of conflict of interest out there. A lot of people are getting paid to make you look the other way, essentially. That's the best way I can describe it. All right, before we dive into the portfolio, why don't we look at the two positions that I've set up, hypothetical positions. I didn't take any of these except for MicroStrategy, which became part of the, actually, no, that's not the one. Sorry, totally wrong. I have hubs. I have hubs. I've taken hubs instead of MicroStrategy. I did not trade MicroStrategy, even though I believe that's one of the only ones that actually profited so far. But if we look at Next Power and MicroStrategy, if you've been following the channel for the last couple of weeks, these are the trades that we set up. And yeah, the returns have kind of gone down this week on this one. On Next Power MicroStrategy, I'm only up 1.78%. That's less than $15. VSCO hubs, Victoria's Secret, HubSpot, that's doing a little bit worse. Victoria's Secret still climbing. We have a $40 return, about 10% so far. But Hubs hit a snag, and I'm waiting for it to go back down. Yes, it's at minus 13%, but at the same time, I'm not really worried. I only have two of those shares. And if you keep following this spreadsheet, I know like it looks like too much, but if you just follow my cursor on the screen where I'm pointing at, you'll start noticing like what this is all about. This is a pair, VSCO versus Hubs. My long, VSCO, Victoria's Secret, and my short, HubSpot. And these are the results down here. These are the pair and index results. And I've also expanded to all of these things now. There's a summary page, but these two trades were just NXT, MSTR, VSCO hubs. These are just two hypothetical trades that I've taken to show you how this stuff works. And they're both about a month in. Not much to show. I'm actually losing about $10 between the two of them. Is it always going to work out? No. But that is why you have 15 of them, not just two. And then if you go back to long and short portfolio, if you look at the summary, a lot of these here will not be necessarily working out the best. You know, like combined return on some of them is minus 58, minus 7, $13. But then you combine them all, and if you look at how much they're returning and the age, it just shows you. If you give these times room to grow, they will. And some of them will be in there for a very long time, like a year. And why would I keep them for that long? Well, if they're making money, why would I get rid of them in the first place? The ideal situation would be to increase exposure and actually add on to the position if something is doing that good. My portfolio risk management does not allow me to put too much into one stock because I'm kind of fully invested on this. And I'm looking to de-risk this as well. I've actually de-risked my long-only portfolio, which I expect to be first hit when this war or conflict, I don't want to say war, hopefully it never comes to that, but this conflict in Iran, when it goes into fruition, and it seems that over the weekend they've done a lot of striking between Israel and US, and Israel retaliating. So me closing off half of my portfolio on Friday was actually a blessing. I looked at, I'll show you what made me pull the trigger, and I mentioned this over the last couple of weeks. I've made an indicator based on all sentiment index, the positioning momentum. And I had mentioned earlier, when I see this thing go through zero into negative territory, I'll definitely be shifting away. Now, VIX is already at 20, and it looks like it's been rising steadily. So this is the time to transition into a defensive portfolio, get in on some gold, telecommunication. There are others to perform well in these times. I don't see my list over here. I could give you a whole list, but we'll get to that in a different video, I suppose. But long story short, I've de-risked my long short portfolio by 50%. I've left gold, telecommunication in there. It's pretty much like 90% gold exposure at this point in time. Reason being is that I have a lot of longs in there, which will be hit. They're doing well. They're great companies, but when a war happens, that portfolio is going to reduce itself because the stocks are going to go down. Wars are not the best for stock markets. I mean, there are companies that will greatly benefit, like the aerospace and defense, that will go through the roof. Obviously, the minerals go through the roof. Anybody mining the minerals, they tend to spike up, but miners, they seem to stabilize, because what we're also going to be seeing with escalation in Iran is also what they've done is they closed the Strait of Hormuz. And what that means is that the flow of oil, which represents like a huge chunk of the flow of world oil through that area, has just been put to a halt due to this conflict. And that is going to have detrimental results on the price of oil. Now, spike in the price of oil will send a shockwave across the whole globe, And this is a potentially very recessionary scenario. And that combined with my hedge hedge fund, mutual fund, and bank positioning going into negative territory, I don't want to be against the herd here. So I have reduced my portfolio, and my long and short is going to start getting reduced this week. Ideally, I'd like to see this in the negative. And is this a 100% surefire method? No, but this gives me the stay ahead of the curve information for me to start transitioning when I see these numbers dwindling. And I've been talking about this for the last 2, 3 weeks that when this goes negative, I will be reshifting into defensive and reducing the portfolio sizes. And I am currently doing that. So let's go back. Also, have you noticed, never mind, let's go back to the portfolio. That's a different subject. Let's go quickly through the summary and what has happened over the week. On Monday, I have covered 5 long positions in Grail, a loss of $283. You see that right over here, and that's all being calculated up here. This is the actual result for the long and short, and these are my results for long only. This has climbed a lot more. It's because I've de-risked a lot, and I've taken the long only positions that were in the profit and I closed them off. So you see that profit here, and that combined profit for the long only, which is closed now, is $2,800. On Thursday, I covered 2 CIEN with a $220 profit. This is in the long and short portfolio. There's that right there. That was a tech sector software rally. If you follow this week, tech sector software has been doing really well. I had a short exposure in that, and so I've started covering those. I bought 13 FRO, which is Frontline, at 37.31 to replace that trade. Then on Friday, I closed my 2 position of CLS, Celestica, and I bought 20 NSER, 25.17. Here is the note associated with that day. Closed off most long only portfolio, leaving gold and telecommunications, predicting market nosedive, i.e. Iran conflict, global recession. Now I wrote this on Friday. Little did I know that on Saturday, U.S. and Israel is going to strike, and they did. So expecting volatility on Monday. If Nvidia wasn't volatile enough for you, just wait till you see what happens on Monday. Mind you, the markets have been pricing in this conflict for some time. What they have not been pricing in is the fact that this is going to hit the infrastructure. This was supposed to be a surgical mission, and it was. They've taken out key targets without targeting any of the country's infrastructure. And the world is reliant on Iran's oil. It is. It's a huge supplier of it. And that is why on Saturday, when they close the Strait of Hormuz, this is going to send a shockwave through the world. And we will see this when the bell opens on Monday. And you see that. Below here is a chart of the long and short portfolio and then long and only. You can see their results. So far, long only is up 17.16, which is 33.5%. And then long short is up 33%. And then long only is up 5% and 5%. Yeah, but you notice how these are performing. What I've done last week is I probably showed this to you already, but I'm showing weekly returns for long and short stocks, my long side and my short side. The 13 up on the short side is a negative hubs, but that's actually been at 17 and it's reducing down. I'm waiting for this one to come back into profit. I'm not really screaming about it. It's only losing 11%. It's very close to my 10. And yeah, so far, minus 13.91. So I'll be staying in it, waiting for it for another week. Maybe I will close HubStop. Maybe I will not. So far, I left it in there. So my overall return for the year running this portfolio, it's been 9.69%, or roughly 3105. my combined alpha, alpha being the better measure than the S&P. If S&P returned 1% and I returned 16%, I would have an alpha of 15. So to date, since January 7th, S&P has returned negative 0.61 of a percent. It's been flat the entire month. It's just up and down, up and down. Since then, I've done almost 10% running this portfolio. Okay, over to the right side. You'll notice that my long allocation, I've added one more gold. This was last week already, but I'm almost 50% in gold on the long side. And my biggest concentration is software applications on the short side. Remember that software rally last week? Well, this is why I got a hit on that. One of them is being HubSpot, and that represents a quarter of my portfolio. But that's roughly where the money's allocated on the long side and the short side. And these are industry and sectors. Long side, short side, long side, short side. You can pause this and decipher it any way you want. I'm trying to be as transparent with my portfolio. This is the actual portfolio that's currently being deployed. And yeah, if you can learn something from this, that's great. If you can't, try again. Watch some of the older videos. I show you step by step how I do this. And you do not have to be a genius to do this. You just have to have a set of rules to follow, some of which you will tweak to your own liking. And it works. It just works. This is the professional approach to it. It really works. I mean, you'll see it for yourself. This is why I'm doing this live. Am I going to show you my trading platform? I'm with Interactive Brokers. I've done this in the past. Yes, I will, except those videos require a little bit more tweaking. I have to use an editor, make sure I cover up some things that are in there, like my account numbers and blah, blah, blah. Like, I don't want those exposed, obviously. So those are not the easiest to produce. These are easier. I'm just starting to put some presentations in, so it's a little bit of a nicer format for everybody to see instead of just a guy in a corner and looking at a boring spreadsheet blabbing away. I know I'm not a best presentative. Sorry, I don't do presentations that well. Totally awkward on camera and whatever, but this is it. You know, if you can look past all that, there is a world of information that I'm giving you that actually matters. There's a lot of stuff being published on the internet that does not. It's just there to make you look in the wrong direction, so you're always losing money, and it's just a vicious cycle. You'll lose everything over this. I mean, if you don't do this properly, and there's a million ways of not doing this properly, and there's only a few that are so profitable that nobody wants you to know about. This is one of them. Okay, quickly, let's go through the portfolio itself. Weekly returns, we've gone through all of that. Let's just go through all of them really quickly. This is Millicom International, Crown Castle, telecommunication. Remember, telecommunication is doing well when there's defensive times like right now. Am I going to be increasing exposure to some aerospace defense coming Monday? Probably. I need to look into some stocks in that regard because those will all spike on Monday, but if this conflict with Iran continues, those will do very, very well. You know, like anything in aerospace, space, and defense takes off during war times. So TIGOCCI, 13.7 return. New Gold Baxter International, 1.6. This is a 1-month-old trade. It's playing out so far. You got to give it time, obviously, but you know, like the spread is up. The prices are drifting away from each other. I'm giving this one time. VFF, Village Farms International versus HubSpot. This one's losing 6% overall, but it's only been less than 2 months. Like I said, Hubs did a lot worse, and it's actually rebounding now. It's going in the right direction. If it continues up, the short side here, if it continues up, I will be closing. It's minus 14% almost. If it gets to like 20, I will close it, replace it with something else. There's no big deal, but I give it some time because it's been minus 17 and it's a minus 14 already. So chances are it will do good. And NESR, National Energy Services. This is the one that I added 2 days ago. And so far, you know, none of this is really doing nothing. I mean, it's flat. So we're waiting for that to change. Barrick Gold, obviously anything gold right now is doing really well. Lineage is a good trade, 14%, but it's been around for 4 months. One has been around for more than half a year. It's okay. It's okay. It's kind of resembling tumbleweeds, but I'll give it some more time and then I'll start liquidating those two. Except for Barrick. Barrick, I'm expecting good things. Because as long as gold goes up, mining stocks will go up. Mind you, mining stocks will not go up this time, same as gold, because of the Strait of Hormuz. Not only gold is going to go up, also the price of oil is going to go up. So mining stocks are highly reliant on operating costs, and those operating costs, a lot of that is diesel fuel. So if fuel goes through the roof, it that eats away at their profits. So they'll be making profits because hey, gold is worth more, but our operating profits are going up with the oil at the same time. So you might most likely these miners are going to spike really up with the gold on Monday morning, but by the end of the day, you'll see those prices come back down because the market will start pricing in the prices of fuel rising and like, hey, their margins are not actually as great. So that's what's going to be happening on Monday. Just that's tomorrow. Keep an eye out. Nesty versus Adobe. This one's doing well. Definitely leave this one alone. Barclays, a bank, Flutter International, bank against gambling. This is a really good trade. Keeping this one open. SSRM versus Roblox. Very good trade. Obviously not changing anything here. Roblox seems to be doing okay. So far, 7.8 return in just over a month's time, month and a half. King Gold Cross Corporation. There's a lot of gold exposure. I have a lot, for obvious reasons. Yeah, this one's doing really well, 34%. FRO was introduced to the portfolio 3 days ago, and it's already doing 2% return. If you look at the spread here and the price action, this should be a very good trade moving forward. Like in a couple of months, I don't know, this could be $1,000 if it continues the way this is going. PDLB, GoDaddy, Ponce Financial, another bank versus GoDaddy. Obviously, we know what GoDaddy does. That's internet hosting. That trade is returning 12%. Pretty good. Newmont Corporation, that's another gold company versus Figma. Yeah, very good. I like the price action. Figma did a little bit run up, but overall it does these all the time, then the price keeps on going down. It's been around for a month in the portfolio. I'll give it some more time and see how it goes. Right now it's losing less than 1.5%. TRX is another new one. That's from last week. It's actually down $11, minus 2%. You'll notice I have no idea why my phone is tapping into my headphones right now, but okay. Yeah, so TRX, it's only okay. TRX was introduced 6 days ago, probably on Friday. It's not 200 and something days. This is 9 days ago, and it's so far losing 2%. Not the end of the world. You got to give these things time. And this company being at $1.81 has a lot more room to grow. Is this something I would normally choose? Not so much. They have a very small market cap. Their financials are what they are. But since they are a gold company and the gold is climbing up, they don't have to have great financials for their price to go up. They go up because their profit margin goes up. Okay, so they're driven by the price of gold, and companies like this, there's opportunity if this thing goes up to like $2. That's a lot of money made right there. GSL Gold, Global Ship Lease, Amerigold Realty Trust. They're looking at 14.5% return. That short is not doing the greatest lately. I will probably be reducing this. It's been around for half a year. and it looks like the price is actually going up. So if you look at for the quarter, it's up 21%. It's been around for too long. Cold is the next one I'm going to liquidate from here. So I'm going to remove this cold while it's in a profit, most likely on Monday. Mind you, it will be a much better profit on Monday because anything that is going down is going to go down with the markets. So will this, but you know, that's the beauty of it. Long and short, they both go down, they both go up, but the spread in between the two is what we're trying to capture. But long story short, I will be looking forward to changing this guy out because it's not going down anymore. It's actually going up. If you look at the average daily moves, cold is actually up now. This is not a good short anymore. It needs to be taken out. And so I will be taking out COLD, Americold Realty Trust. Core Mining, Kraft Heinz. Very good trade. Obviously, gold side, 62% return. Kraft Heinz has only a 2.42% drop. I may be looking to replace this guy. So far, it's doing okay, but you know, Kraft Heinz seems to be a little bit of a tumbleweed. It's not doing much, just sitting there. I'll look into replacing that one as well. And that, you know, that shows it. That's the whole portfolio. Um, the ROI on the long and short return is 33.5% with the market alpha of 34 and 13. And then long only return is 5.6% or 5.77% return alpha. So I've reduced the long only exposure. It's only $10,000 on the long side. I will be reducing the exposure on long and short and looking up for opportunities. Yes and no. If I see something come up, I'll look into options, but I'm not the biggest fan of options. So I like that long and short portfolio. Just reduce it when the time comes and expose yourself fully when the times are the volatility is not as high. With the volatility climbing up, if it goes above 25, I will definitely be reducing this to 50% of its value, just to protect what's in there and lock in the profits. You don't have to be greedy all the time. You can be smart about it. And trust me, hedge funds and all the big institutions are already doing this as they see the shift in the process. A lot of them will be panicking now over the weekend, and on Monday there'll be a lot of de-risking happening due to that escalation of the conflict in Iran. And let's hope that everything works out for the best, for the sake of people there and all around the world and military personnel. Let's hope that everything goes well and the escalation comes down. It doesn't lead to a full-out war because nobody needs that. Let's end this video with that, and hopefully you've learned something about VIX. From now on, every video is going to have a little bit of information like this, something to learn, not just a boring chart. But like I said, the more you're going to look at this, the more it's going to make sense to you. This is just the way I see it, but just follow this portfolio if you want proof. There's a million people out there that talk the talk, and they don't show you what they practice. They'll tell you to buy something, they'll tell you to sell something, they'll tell you to write options and sell this, sell that. 99.9% of what you see on the internet is BS. It is stuff to smear some soap in your eyes so you look the other way, so you don't see where the opportunities are, or so that you're left behind holding the stick when everybody's gone from the playing field already. Yeah, is it time to de-risk? 100%. Time was already last week, the week before. I kind of went out on the last bell and like de-risked my long only portfolio, and I left gold only thinking, yeah, well, if there's an escalation, those assets are going to go up. And so I have a huge exposure to gold mining. I don't actually have physical gold. I only have the gold mining. So I'm imagining a spike on Monday and then come back at a higher price than we opened on Monday, but it's not going to be as far as the market euphoria first thing in the morning that you're going to see when the markets open up, and there'll be some gaps. Okay. Uh, yeah, that's it. Let's end this video here. Thank you very much for joining me. There's another one coming up next week. I'll try to figure out what we're going to do this one about. Today was about volatility and how to protect yourself. Next week we'll dive into something else. Thank you very much for joining me. Don't forget to subscribe if you haven't already. And I'll see you next week. Have a good day.